Uh, Thank you. A very good evening to all friends. I, Sanjeev Singhal, Central Council member and chairman of the Committee for Member in Practice, welcome you today in our VCM on reversal of ITC and the ineligible ITC under Rule 42 and 43 under GST and its disclosure, and also the Code of Ethics program. Both are very, very important topics. So Code of Ethics has been issued by the Institute of Chartered Accountant of India. It's on the lines of the ISBA, and GST, of course, as practitioners, all of you know the importance. And we have two very esteemed speakers and two good friends as the speaker today. CA Sunil Bajaj, who is also a member of the Ethical Standard Board of the Institute of Chartered Accountant of India. He'll be speaking on the Code of Ethics. And CA Jagjit Singh Jags, who is a renowned speaker on the ethics as well as on the GST, and has been recently elected to the regional council. So congratulations to you, Jagjit. Let me briefly introduce Sunil. Sunil has over 23 years of experience in financial audit, risk management reviews, business process reviews, and extensive experience in the services in the automobile industries. He is an alumnus of the Shri Ram College of Commerce and is a certified internal auditor from the International Institute of Internal Auditors, Florida, USA. He is responsible for rolling out various firm-level risk management policy and is heading the independence function in his firm. He was nominated for a global project also on the independence compliance. He has received many awards within the firm, and as I mentioned, that he's a special invitee member of the Ethical Standard Board, and currently is a partner with Ernst & Young. So we welcome you, Sunil, to this program. Of course, you are not new for our members, and they would love to hear you once again. And before I hand it over to you, let me introduce Jagjit Singh Jags. Jags is a commerce graduate from Delhi University, 1998 batch. He's a 2008 batch chartered accountant, and he has done a certificate course on the concurrent audit of banks, forensic accounting, GST, and anti-money laundering. All 4 certificate courses were conducted by the ICAI. And he's a prolific speaker on soft skill accounting, accounting standard, professional ethics, and GST. And he's been awarded as a best GMCS faculty by NIRC in 2015. And of course, now all the faculties are available on the seminar as well as the webinar mode. So welcome you, Jags. So I would now like to hand it over to Sunil. Sunil, I would request you to kindly, explain the Code of Ethics, including the recent changes which have happened, to our members in a simple language, which, from in their day-to-day, which they can understand and apply also. There may be some questions also, which will be taken by the MOC once your session gets over. So over to you, Sunil, and thanks a lot for your time.
Thank you, Chairman, sir. Thank you very much for inviting me and giving me this opportunity to connect. And I'm told more than 2,500 members have joined. So a great platform to interact. So thank you very much. And very good afternoon to my co-speaker, Jagjit ji, and to all other fellow members and present today. So thanks a lot. We'll go ahead. I think in the interest of time, I'm just going to start presenting my screen. Just if somebody can tell me if it's visible.
Yeah. Yes, it is visible.
It is visible. Yes, you were saying something, Sanjeev ji. Were you saying something?
No. I was not sure whether you have been made a co-host. But since your screen is visible, so I'm sure that you're allowed.
Great. Okay. So people should not take offense. I thought when we are interacting, we can always go back to, in the virtual learning mode, we can go back to learning something which is taught in the, primary schools also. So something on the screen, if others just can see what are we learning. So anybody, Sanjeev ji, since you can unmute yourself and tell me, so what do you see as the first box over there?
I see various types of animals.
And the first or the second one, if you can tell me the second one with the
butterfly.
Butterfly. So that's B for butterfly, right?
For butterfly, C for cat.
Oh, great. So I'm trying to get you there, but if I take you down, probably in some of them down in the second last row, you may struggle. Yeah. So the simple way is like, okay, the pictorial connect is better, and with such a large audience, I thought a pictorial connect will better. But let's make it easy. Let's make it easy for everybody, and let's make everybody go through and take the order. This is the alphabets everybody would have learned. So is it possible for the audience to unmute and speak, or is it not possible?
No, that's not possible. They can post their questions, which will be asked by them. Yes.
So I don't know, how should I ask? I just have this one question to begin with, everything is all right. People relate to this. What is there on the screen? Everybody knows this. Or Jajiji, you can, ABCD. So Jajiji, I think you can unmute yourself. So let me ask you, is everything all right here? This is what we all learned. I don't want to press the chairman, sir. I just quickly want to ask someone else. So Jajiji, if you can tell me, or everything is all right.
So I think there may be some problem with this mic, but the order to me seems to be changed. This is not the same. It's a A B C D F E G H I J K L M N O P Q R S T. So I am also an auditor.
So what's wrong?
So normally we write E first and then we write
normally. F. You mean to say normally? You're a true auditor. Normally, that's the way it should be written. So yes, E comes normally. What is normally? So yes, E does come before F. And thank you very much. Thank you very much for participating in this the quiz for me. And what I meant to convey is that our ethics, to our fellow members, to our chartered accountants, to all the audience, I would say, Sanjeevji is right. E comes before F. It is taught to us right from our basics, from our school days, from the most, when we begin our studies or education or anything, that's where, E comes before F. And I would like all of us, and I've been saying it for 10, 15 years now, that ethics must come before fees. Ethics is what? What is ethics? If ethics is there, and if we have a code, and that's why, we are here to go through the significant changes that have been made, I will cover all those. But what is a code of ethics? Why do we all need a code of ethics? We need a code of ethics more so because we've all grown up. We have all grown up with values in our schools, with our friends, with our families, from our parents, from our grandparents. We all have inherited a set of values, core values. Our upbringing brings in that, what is right, what is wrong. What is acceptable, what is not acceptable, what will be appreciated, what will be punished. So these right and wrong is something that we all know. And that's why one may ask, why does one need a code of ethics? Everybody, knows what the CPC or the law of the land is, what is right, wrong. Then why does one need a code of ethics? So there are various definitions around a code, and what I tend to see is that it's the most common policy or standard which a group is expected to adhere to. So if we are all chartered accountants, or if there are company secretaries, or if they are actuaries, or if they are any other professionals, they tend to have a code, because that brings in a consistency in the approach. What are the principles that we need to follow? What is it that is expected out of us? What is expected when the people engage a professional? What is it that they expect out of us? Be it objectivity, be it impartiality, be it competence, be it maintaining confidentiality, be it not looking down upon a fellow professional, not demeaning anybody, having respect for everyone. So these are some core values or expectations which, when put together, take the shape of a code. Okay. And when we have had a code of ethics, and the committee of members in practice has given this opportunity, I would say there was always a code that we had. And globally, ISBA comes out with a code for the independent auditors, professionals. And ISBA came out with a code back in 2005, basis which our code of ethics of 2009 was formulated. So 2005 they came out with a code. 2009 we had a code. Thereafter, globally, ISBA went on to revise the code, the global code, many a times. But in India, we were, there were many thoughts, there were many working groups, but we couldn't come out with a new code, and it took some time. And eventually, it came out. We came out in India with a code of ethics 2019. So from 2009, straight away after a decade, we came up with a 2019 code of ethics, and it has been made effective from 1st of July 2020. So it's roughly a year and a half or so that we are already into the new code. But still, being as Sanjeev ji introduced, being part of the ethical standard board for last many years, a co-opted member or a special MIT member, I am privileged to deliberate upon many matters that come in front of the the ethical standards board. And so we all feel that yes, there is still a need to operationalize this, to familiarize everybody, to go out and talk to everybody, because to expect someone to read the 3 volumes, I'm sure we refer to it as and when necessary, but to expect somebody to go through all the changes is a difficult task. So we'll try to attempt it in a shorter than a 1 hour that we have today. So there are multiple volumes, volume 1, 2, 3 that is there. And I will take it that on 30th June, in the 393rd meeting, the council gave a go. The times and seeing the challenges that can be posed to the members in practice. 3 critical elements that you can see on your screen are NOCLA, the fees and relative size provisions, and the taxation service to audit clients. And we'll cover all 3 of them in due course today. These were deferred for implementation, and roughly around 2 more years was given. So instead of 1st of July 2020, we have them becoming applicable from the 2 months from now, approximately like 1st April 2022. So all these will become applicable. We'll cover all the aspects. The 12th edition of Code of Ethics, it's the first time that it has been segregated in 3 volumes. As I said, various programs have been conducted, and we continue to do them. So what is in there in the volume 1? As I said, the NOCLA, non-compliance of laws and regulations. We are expected to report to the stakeholders, to the regulators, to the bodies, if we come across in our course of performing the audit, if we come across any non-compliance, we become aware of a non-compliance with laws and regulations, then we are expected to report the same. I believe in the CARO, some latest developments have come as a separate topic. It can get covered. So, and as I said, it becomes applicable from 1st of April 2022, 2 months hence. Then there are certain restrictions on taxation services to audit clients, which were not there in the earlier code, which also become applicable from 2 months hence. Prohibition on management responsibilities to the audit client. There was no such provision in the old code. There's a safeguard approach, safeguard on fees from a single client. If you're getting a significant fees 2 consecutive years, there are certain safeguards that is there. Again, this provision is applicable from 2 months hence. Duty of an accountant in case of a breach of independence standard. All these are something that is there in the new revised code that has come into being, and they were not there in the 2009 code. Independence requirements for audit and review engagements. So there's a 4A, 4B kind of a distinction. Audit and review engagements have been classified as one, and other assurance engagements have been classified in one bucket. Earlier in the erstwhile code, we only had a common literature on assurance engagements. Independent sections have been renamed as independent standards. A very important change, though in English and we started with alphabets, one may say a should and a shall is same. No, it is not. So in the drafting, a lot of emphasis has come on the word. Earlier, if it used to say should, now it is saying shall. So if a practicing chartered accountant should do something, and it's a code of conduct under the guidelines, so it could be taken, people could be taking it in the past. I should do it. What if I don't do it? I couldn't do it. No, now it has been changed to say shall do it. So it's a requirement. So the sections we'll say are going to be alphabetically, they are in the new code of ethics. They are numbered or organized with R before them. And the R stands for requirement. Okay, so that's very important, because if any R required provision is violated or not complied with, then you stand in contempt. You stand in contempt, and you are you can disciplinary action can be taken against you. Just to bring in a consistency, again, a carrot and stick approach. The need should not arise. Everybody should be able to comply, and that's what it is. Increased clarity of responsibility of compliances. What are the compliances on a firm? What are the compliances on the individuals within the firms? All that is there in the new code. But before I go in there, I would say, when we say, why should we be ethical? Why should we be impartial? I'm a father of two sons, and if they are 14 years and 11-year-old, even if they go down, they want to play. One person wants to play basketball one day, one wants to play cricket one day, or if they are fighting or having a disagreement on something, I as a father am expected to come in as an objective person, a rational, objective, unbiased person who will hear out the both sides and arrive at a mutually acceptable outcome, which is fair and objective. So that's why I would say a code of ethics or any ethical requirement in the life will come in your family, will come into your office, will come into your professional relationships, will come into your friendships as well. Okay, so ethical requirement is there in all walks of life, and that's why it is also there in our in the profession, in our chartered accountancy profession. That's why the name that is given to us is professional accountant, and though it was the same, the individual who's a member of the Institute of Chartered Accountants of India is defined as a professional accountant. However, globally, the ISBA, they use the word professional accountant in business, but to be consistent with our Chartered Accountants Act, we have gone ahead and said professional accountant in service and professional accountants in practice. So that's how we have always understood it. So that's one, terminology difference that we had. This is the contents of the last code. I will skip that and straight away come to the contents of the new code. As I said, 4A, 4B is talking about independence of audit reviews, independence for other engagements, professional accountants in public practice, professional accountants in business. All these are sections which are there. It is definitely, I'll skip this. Students shall have discussed the Chartered Accountants Act. I've covered this, that if you don't end up complying, then you are in contempt and you will be in violation of the CA Act as well. This, if I can just somehow make this go away. Okay. I'm not able to see the screen, so if anybody is speaking or there's any question, I would expect Anilji or anybody else to guide me. Otherwise, I will continue. But at any point in time, anybody has a question and they want it to be taken up then. And if the moderator prompts me, I will be able to.
Sir, you may kindly continue.
Okay. So,
sir, you may kindly continue. Question will take end.
Perfect. As I said, the designation of R is a requirement, and that's why anything that is prefixed with an R in the 3 volumes of the Code of Ethics, that needs to be complied with. And if there's an application material, which is an explanation, which is a suggestion for action, matters that we need to consider, that is prefixed with an A, alphabet A. That's how this construct is. NOCLER, as I said, the non-compliance with the laws and regulations, anybody, member in practice, member in service, they come to know of a non-compliance at the entity where they are either auditing or they are working, then they are expected to disclose that, bring that out, and not turn a blind eye to that matter. When the regulators are trying to achieve a purpose, that all of us become their eyes and ears, and we help point out any non-compliance with local laws and regulations. Now, to begin with, and it's beginning with 1st April 2022, and I'm sure eventually a couple of years down the line, it will go to all kind of our clients. To begin with, it is applicable to listed entities, applicable only on our audit assignments, and in case a professional accountant is in service, it's applicable to employees of those listed entities. So that's the applicability, and my content is that this is a beginning. Eventually, once people operationalize this, we understand it, we become comfortable, then it will come on to the non-listed entities as well. What it says is that, laws and regulations that have a direct effect on the determination of material amounts and disclosures in the financial statements, Income Tax Act, Companies Act, SEBI, RBI, foreign exchange, money laundering, terrorist financing, proceeds of crime. So all these are relevant to our audits or the work that we do. And hence, if we come up against any non-compliance with any of these laws and regulations, we are expected to report on the same. Matters, obviously, you can't be tasked with something which is not possible in the time frame that we engage with a client. So anything which is inconsequential, anything which is a personal misconduct not related to the business activity, any non-compliance other than by the clients, the employer, those charged with governance, audit committee, management, board of directors, you don't need to get into that. Okay. And only when you encounter it in the course of your providing a professional service, that's when, if you discover something, you're obligated to report that, to bring a disclosure of that in your expected behavior out of the code of ethics. We'll move on to the independent standards. Independent standards in the 2009 code, there were assurance engagements. I've covered that there are two sets now. Breaches of the code. If a firm conducts a breach of requirement, then you can address it. The new provision that has come in is, if there is a non-compliance, if there is a breach, inadvertently something has happened, you are given a window to address it. How do you address it? You end that problem. You end you end whatever caused that breach. You suspend or eliminate the interest that created the breach, a personal independence breach, securities you are holding, shares you held, anything that you're there. It can be a disqualification and appointment as well. That will be under the Companies Act and all other provisions to be respected. The more stricter of all will apply. But in a generic sense, if you can suspend, eliminate the interest which created a breach, it's a safeguard. Consider the applicable legal or regulatory requirement and apply them is another safeguard that is given. Now, a new concept, and what we are doing is we are interacting and seeing what are the changes. So a concept of key audit partner has come into the new code of ethics. Now, what is a key audit partner? We have always known the audit partner, the engagement partner. What do we mean by a key audit partner? And does that mean more than the person who's signing the financials? Answer is yes. You're a signatory to the financials, you are the signing partner, you're the audit partner. But any other partner level person and an individual who's responsible for the engagement quality control review, a person who shadows you, who works with you and ensures that the engagement, the audit engagement is done with the full quality control expectations, that person is also a key audit partner. And people who are making key decisions, they are involved in the judgment, significant matters are being reviewed by them, and the calls are being taken. All of them will form part of a definition called key audit partner. And we'll quickly see how and where it impacts. So depending on the circumstances and the role of the individual on the audit, other audit partners might include, for example, audit partners responsible for significant subsidiaries or divisions. Even they will be termed as a key audit partner. Firm rotation, we are all familiar. The old code of ethics did not have anything on a partner rotation. Okay. And the firm rotation requirement were there. But in Companies Act, when the Companies Act came up, it specified the firm rotation. Under the revised code, the partner rotation and the audit firm rotation both need to be complied with. And we'll quickly see where the distinction is coming. This is a very important slide, I will say. We all know about the 7-year time which is permitted to stay on an engagement. That remains the same. There is no change. The audit partner can be the same account, be on the same audit engagement for 7 years at a row, continuous. But earlier in the 2009 code, we had a 2-year cooling off period. Now the cooling off period has been increased from 2 years to 5 years for the engagement partner. It is 3 years for the engagement quality control reviewer. And it is 2 years for all other key audit partners. So that's why when I was saying the definition of key audit partner is very important is why? Because if a person qualifies as a key audit partner, then after a 7-year period, there is a cooling off period that's required. And that's where the distinction amongst your roles comes into being. Partner rotation, Companies Act says 5 years, but if a company, theoretically, if a company wants, they decide that they want to do it at a shorter period, they can do it at a shorter period. Partner rotation requirements, we are all aware, are there by RBI, in NBFCs and regulated entities by RBI. We have a different set of rotation requirements which we need to comply with. Now, during the cooling off period, if a cooling off period has been given, it totally means you need to disengage. You cannot. One needs to understand you cannot be giving a technical or industry specific advice on a transaction or an event. You cannot be reviewing anything. You cannot be a relationship person. You cannot be having a significant interaction with the senior management or those charged with governance, or having an outcome influence on the outcome of the audit engagement. So please understand, when you have been told that you have to have these cooling off periods, in that period, please stay away from that client, from those charged with governance, and the calls being taken, the significant issues being discussed. Kindly do not be involved, because otherwise you will be in violation of an expectation, or the violation of the rotation requirement that are there around key audit partners. Management responsibilities. Earlier code, it didn't have any mention of this, but in the 2019 version, which has come into being, the firm shall not assume a management responsibility for an audit client. Now, what it is? Now, very significantly, it has been said that providing an advice and recommendation to assist the management is not a management responsibility. Doing any administrative work, word processing service, statutory form filing, submitting of such forms, very non-judgmental, non-subjective, procedural matters. It's been very well clarified in the Global Code of Conduct by ISBA, and our code has adopted the same, that these 3 or 4 bullets that you're seeing will not be seen as a management activity or a management responsibility. What additionally has come in, and this is primarily coming in from the Companies Act, that you can't be doing internal audit, you can't be doing accounting and bookkeeping services, you can't be doing any prohibited valuation services, IT system services, because they all lead to the financial statements. So these are all coming in from the Companies Act, the restrictions on non-audit services. They've been incorporated in the 2019 code as well, and it says that recruitment services, any background check, any kind of a search of candidate services, we shouldn't be doing where it involves our audit clients into being. Taxation services. This is going to be very critical. This will pan out, and a lot of clarifications will come in the due course, but very clearly in the new code, there is a provision which will become applicable from 1st of April 2022, that certain tax services which pose a self-review threat or advocacy threat, they cannot be done. And I will just take it like tax return preparation, be rest assured that's not coming into any kind of a restriction. But when you say tax calculations for preparing accounting entries, which will then be audited by our own firm and our own team members, that poses a self-review threat. But wherein it's a tax planning or other tax advisory services, which a safeguard can be applied to the extent like team separation, and it is not a matter of an audit by us, those are going to be acceptable. So this is an evolving topic. We will see this. Tax services involving valuation, we might perform only where the result of the valuation will not have a direct effect on the financial statements. And also there was an existing requirement that it was, if it's required by a regulator, it's required by a regulator that the auditor does a valuation, then that's also acceptable, and it should not have a direct effect. Now, assistance and resolution of tax disputes. Now, that's where it poses a problem when you are assisting and you're going in front of a court or something, and you're advocating or you're talking on behalf of your client. You are putting forward their interest and trying to save them from an adverse outcome. Then you're seen as a team. Then you're seen as advocating them, or there's a common interest. Maybe your fees is dependent on the outcome. So all those might create a self-review or an advocacy threat. And that's why we need to be very careful of what exactly we are doing when we are saying if we are doing assistance and resolution of tax disputes, and up to what level, whether material or not, all that becomes applicable. Safeguards, very clearly, in the old code, there was something called a clearly insignificant, trivial, small matter. In the new code, it doesn't stop at that. The new code says you need to have a safeguard approach to eliminate the threat, and the threat could be a perceived one as well. As we say, independence in fact, independence in appearance. So we have to apply a safeguard which goes on to eliminate the threat or reduce it to an acceptable level. The impact was much more. We did something which brought it down to an acceptable level. It's been defined over here as a level of which a reasonable, rational, informed third party knowing all the facts, will conclude that our independence is not vitiated, our objectivity, our impartiality, all that is intact. If a third party can conclude that, it will pass the test of acceptable level. I will skip this. It's covered. Close and family members, close and immediate family members. Otherwise, in the past, in the 2009 code, they had replaced these terms with a term called relative. Okay. Now for the clients other than company, if the client is an individual, immediate family and close family in the global ISBA code will apply. Okay, so if you're a company, then we go by another definition. But if it's a non-corporate client, then we'll go by close family being a parent, a child, brothers, sisters who are not immediate family members, and immediate family members is a spouse, equivalent, or dependent. Dependent, I have understood it to be a person who, in the entire year, more than 50% of their expenses are met by you. So if your child is still in a school, still in a college, they may be earning, but their earnings are less than 50% of their expenditure, then they'll still qualify to be your dependents. And anybody who's beyond that dependent, the close family is a bigger net. Immediate family is a subset. Okay, that's how it works. And I'm just bringing out these differences. When one encounters the actual situations, one will see that the rules may be slightly different for a close family, maybe slightly different for an immediate family. They'll be more stringent always for an immediate family. They'll be less stringent for a close family member, and they'll be next to negligible for a non-family member. The public interest entity, the new code of ethics that has come into being, it has a concept called public interest entity. This was always there globally in the various parts of the world for last 2 decades that I've traveled and I've done work on independence and codes and all. It was always there. Good, we have bought in. And very quickly, if I say it's a listed client, is definitely a PI, an entity which is defined by a regulation or a legislation as a public interest entity. Any regulator or legislative body has defined in the jurisdiction for a client or a body to be a PI, a public interest entity. We need to follow that. Any entity for which an audit is required by a regulator to be conducted in compliance with the same independence requirement as such as that of audit of listed entities will also fall in the definition of a PI. We may say that banks and insurance companies are to be considered as public interest entities. Let's be simplistic. Listed entities, banks, insurance companies, all these fall under the definition of a public interest entity. There are other provisions around gifts and hospitality. Again, as I said, it's always we should appear to be independent as well. We should not be accepting such gifts, such hospitality from our clients that makes a person think that the affinity is beyond a professional relationship. So definitely we should not be accepting gifts which a third party will believe will have an impact on our judgment. If we find any error, and because we were wining, dining, getting so many gifts, going on holidays together, enjoying the hospitality of a client, then to be firm with the client and keep the objectivity intact is something which is seen as very difficult. So please avoid the gifts and hospitality which give rise to an appearance issue there. We'll go to say the next part. Okay, documentation goes without saying. I've always maintained what is not documented is not done. All these aspects, when have we communicated with the previous auditor? When have we communicated with those charged with governance? What actions were taken? If any knockler was discovered, whether that has been communicated, how that has been communicated, any significant judgment that has been taken, whether that has been documented. So documentation around that, every professional accountant is encouraged that all such facts need to be documented. Fee, the relative, as I said, this has been deferred. New paragraph which provides a safeguard to be taken if the fee dependency of more than 15% on one audit client for 2 consecutive years. Out of the whole revenue bucket of ours, if for 2 consecutive years, our revenue portfolio comprises of more than 15% fees from one particular client, then there are certain safeguards that need to be applied. Immediately, it doesn't say that you need to leave the client. No. But for objectivity to be held high, it prescribes a set of safeguards which will need to be implied from the next year onwards. So exceptions are there to the rule that where total fees of the firm is less than 5 lakhs, please don't get into it. Audit of government companies, public undertakings, nationalized banks, the list is there. It doesn't apply. And they are definitely subject to review and appropriate clarification to be given through questions and answers. So as we go into this, this will get applied from April. I'm sure a lot of questions will get asked, a lot of practical scenarios will come up, and the institute, the council, the ESB, all would come up with guidances on what is acceptable, what is not acceptable. Now, criteria of indebtedness. Now, earlier there was no materiality of loans. Back in 2005, 2009, I think I remember reading that 10,000 rupees limit somewhere in borrowings and all. But the concept of materiality of loans and guarantee is there in the new code in determining whether a loan or a guarantee is material to the individual. Now, the individual may have a combined wealth. Every member here attending could come from a different background. All of us, with all due respect, could have a different financial standing. So even that, so the value with our combined net worth, okay, is something which has been given an importance, because not everybody can be impacted by every amount. That's the practical dispensation of the fact that has been taken. On professional appointment, there's a new provision, detailed guidance on client and engagement acceptance, know your client, which is like a banking rules. You see, you have know your client KYC guidelines. Similarly, you know, the institute came out with a know your client backgrounds. I would say, without going into that, just any and every client who walks through the door with a bag of cash or an ability or a checkbook, let me say, with the ability to pay and willingness to pay should not be accepted as a client. You know, our reputation is at stake. Who we work with, what kind of challenges they pose later. So their background, their integrity check, their background check, who are their consultants, who are their law firms, whose recommendation are they coming to you from? It is very important before we accept a client. We should, it's like, I've said it on many occasions, it's like marriage. You know, if you're getting into a marriage, you definitely will go into checking the family's background. I'm talking about arranged marriages here. But even if otherwise, you would like to know the nature of the person, the integrity of the person. So I would say, please, on all your clients, do a KYC or have a background check done, because it can impact your reputation and reputation of the profession to a great extent. This is what challenges you get later. The contingent fees, again, till 2009 code, it talked about percentage of fees contingent is not allowed. Now in the new code, when you say there is a general prohibition, but the rule which says is the activities which are permitted for which you can take contingent fee are any other service or audit as may be decided by the council. So the council from time to time is expected to come out with guidance on where the members are permitted to have a contingent fee. So charging of fees by members enrolled as insolvency professional, rendered either individually or as an entity under the insolvency code, is allowed. Fees for rendering non-assurance service to non-audit clients, it's allowed. So that's my understanding, that these two are permitted for the time being, but the council may add more to them later. Till date, these are the two on which your contingent fees allowed. Applicability of provisions, for members in service. I will skip this. We are here as members in practice. So that covers my changes in the volume 1. Anilji, I'm just a little mindful of a clock. If somebody can tell me how much more time do I have? I would just see the invite. Okay, while continuing. Okay, I have till 4:30, so I have 20 more minutes to go in. So in the volume 2, when we come into the volume 2, the 5 most important changes which are there vis-a-vis the 2009 code are talking about is, the changes which were led by Companies Act, auditing and accounting standards. Those are the changes that have been brought in there. Certain council decisions and clarifications which Ethical Standard Board has given and the various committees have given since 2009, because remember, from 2009, till 18, 19, for 10 years, we didn't have a revision in our code of ethics. So what all decisions and clarifications that were taken in that decade have been incorporated in this volume 2. The advertisement and general, advertisement and guidelines, they have been incorporated. Solicitation, advertisement, signboards, many things we deliberated, in the last few years. I've been part of those discussions. On many of those discussions, whatever practical and acceptable changes were agreed upon in the meetings, they've been brought in the volume 2. Also, when we were doing that, we took into the fact that, management accountancy, many other professions that have come into being, they are out there on the social media, using the, benefiting from the medium of advertisement or reach out to their customers, push, pull, everything. So all those were factored in and coming into the digital age, coming in with the websites, coming in with the way and medium, changes in the way and medium of connecting with people, networking. All that was factored by the council members and the ESB members when they came out with the guidance on solicitation, advertisements, everything. So structural changes, very, very fast I'll go. These are there are all paragraphs are numbered. There are titles, as I said, requirements, clarifications, all that is there. Administrative services, a new provision in the 602 code that is coming in is mechanical work, submitting forms. I covered this, is not a management function, not a management responsibility. You can do it, but definitely where you are going beyond advising, where you are stepping into the shoes of making decisions or acting as management, interacting with the lawyers of the client, or going and presenting in front of the regulators, representing, all that will be seen as a management activity. Even something, if it's so routine that you're becoming part of a day-to-day activity and the client or the organization relies on you as a control for their day-to-day operations, then also you are stepping into the management responsibility role, because we can do a one-time review of something. We can give a advice improvement opportunity on one thing, but if we become a mechanism of every week, every month, some control to be enforced, then no, that is a management responsibility. Insurance, financial advisory services, there's a guidance there. I will skip this. Valuation. This is an important one. Valuation of shares in business and advice regarding amalgamation, merger and acquisition. In earlier part, there was a section. Here it very clearly in the new one, it says that any advice in consistency with the Companies Act and the provisions that are there on the valuation and valuation rules, then that's permitted. I'll skip this. These are the few decisions that were taken in that, what will be there on a visiting card of a member in practice. Members being director of another company, political parties, CA cells and all that, please do not mention that on your visiting cards. However, if you are an insolvency professional, you are a registered valuer, you can bring it in on your visiting card. I do remember that we all grew up knowing that other than a CA, you can't write anything. So this is what has been brought in as a change. And I'll skip this. Referral fee. Earlier, I remember the referral fee was always taken as a taboo topic and we were not allowed. But now under the new code, with certain safeguards approach, I'm familiar with one, like the end client or the paying client is familiar that a referral fee is being earned by a chartered accountant. So then that is a safeguard, that if a client knowingly for certain service or an introduction or is paying a referral fee, then at least they will be objective in their decision of appointing the other person on which you are getting a referral fee. So if with the due disclosure, full transparent disclosure, it is kind of acceptable in a threat and a safeguard approach. Let's skip that. Use of CPA on visiting cards. Earlier it said that no, you can't be using that. Mentioning qualification of accounting institutes which have a MRA understanding or arrangement with the ICI, they all are permitted. So I'm not only saying for CPA, any and every institute or a body which has a memorandum of understanding with our institute, their qualifications you can mention on your visiting cards. Sponsoring activities. We had a silence. We had a complete silence in the old code. In the revised code, it says you're not permitted to sponsor an event. However, you may sponsor an event conducted by a program organizing unit of ICI. So if the institute or the fellow members for the profession, a knowledge sharing session is being organized and you become a sponsor to that, people will not see it otherwise. But if you know any religious event, any sports event, any other event, that's a strict advertisement. We don't want our members to go out in the market and try to win work basis that kind of an advertisement. It should be a healthy competition with respect, and thus it was limited to this activity. Members sponsoring activities relating to CSR may mention the individual name with the prefix CA. However, the mention of the firm name or the CA logo is not permitted. So if you're doing a CSR activity, pandemic times, many people have done that and they're doing it, and you prefix a CA as an introduction, that's perfectly all right. But please don't bring in your member firm's name there. These are okay. I'll not very. No. So size and all was, deliberated. The signage and the board outside office, in an office complex and in your house and everything. Look, we deliberated that at length. Then we said, look, we don't want to be coming out with a size 18 inches, 2 feet. Doesn't make sense. And nowadays, if you send something to someone on a WhatsApp or on a digital platform, whether a person zooms it and takes it up to the size of the entire size of the mobile screen, and everybody's mobile size changes. So I may put a passport size photograph. But now when I'm zooming in, zooming out, seeing, it's open. Likewise, glow signs to be used or not. So we totally came up with a suggestion that while keeping in mind the appropriate visibility, the illumination of the signboard may be decided upon. It should not be very, what should I say? It should not appear cheap. It should not bring disrepute to our profession. So that respect is something that we expect our members to maintain. And if the ESB or a disciplinary committee is given examples of someone who's doing something to the contrary, it will be a judgment that will be applied. Skip that. Skip that. This was, no duty was cast on a previous auditor. The duty is cast only on the incoming auditor. The 2009 code, when we have an expectation with the incoming auditors supposed to communicate with the outgoing auditor. Now you send it by a registered post. You have a proof of delivery. But then if always the challenge was, what if the previous auditor is not communicating? The previous auditor is not responding. So in the new code, it is important that on the request of the incoming auditor to the retiring auditor for providing known information regarding any information of which the retiring auditor's opinion, the incoming auditor needs to be aware before deciding whether to accept the engagement. Retiring auditor shall provide the information diligently. So the new code brings up a requirement that the outgoing auditor must reply within a reasonable time to the questions being raised by an incoming auditor. This was missing. This teeth or this power was missing in our earlier code of conduct. So here, these are these examples that we discussed. If the premises is logged, what do you do? Communication received back by the incoming auditor with office found logged written on the AD shall be deemed as it has been delivered. If the firm was not found at a registered address, what do you do? If the communication comes back and we have proof that this has been done, it will be it was not really served and that he was not responsible for such a non-service. So the incoming auditor will not be found non-compliant if he has evidence of this. And in case of certifications and all, earlier it was a healthy practice. It has been taken away, not required anymore. I'll leave this. Confidentiality. This is very close to my heart. I always believe that we all, as practicing chartered accountants, in business, in practice, in service, we all need to uphold confidentiality at our employer, at our client side. So there was clearly a thing that appropriate authorities to give consent. A sole proprietary concern, the consent may be given by the proprietor or his constituted attorney. Now, in the revised code, what it says is, the commentary is modified so as to mention that the appropriate authority as the one from whom to seek consent is In the example will be sole proprietary concern by the sole proprietor, constituted attorney who's legally empowered to give the consent. It would not be material as to which representative of the client actually accords such consent, as long as it's a representative. As long as that consent has come, our confidentiality arrangement would be met. And where does this come? When we are communicating, when we are sharing with the be it NOCLER, be it our reservations, reasons for resignation, material findings, judgment errors which we don't agree with. So all those, if we are communicating and we have these consents, we have these communications, it will not be a breach of confidentiality. I'll skip these procedural things. I'm skipping, just mindful of the time. So we have some questions. These are procedural changes. Advertisement guidelines, I don't want to cover them today. These are again our purpose of the ethical standard boards. Purpose and objective has been redefined. Terms of references are that every 2 years we will revisit the purpose and we'll align it with the with the global ISBA purpose. So 3 is not there. So that's where we are. I would just be mindful. We have a couple of minutes. So Anilji, anybody from the moderator, any questions that are to be taken up, please?
Sir, thank you so much. It was the wonderful deliberation. Can you hear me, sir?
Yes, I can. I hope every other member can.
It was wonderful deliberation. I have received one question, sir.
Please.
It is relating to the tax audit. The chartered accountant is saying, the member is saying, if during the tax audit you find non-compliance, not by the auditee, but by a third party of the auditee, which is impacting overall compliance, how this should be reported?
Well, a tricky question, a very good question. I am afraid my understanding, and it may not be entirely correct, my understanding is that the NOCLER is on your client. The NOCLER's requirement is, when we read it together, is vis-a-vis your own client. So a third party, a supplier, a vendor, a non-compliance at their end, which we discover during the audit of our client, I would safely say I am not of the understanding that our present requirements are going that far. Anybody else has a different view, I'm ready to hear. Many learned people are there. Jagjeet is there, the speaker for the next one. He or anybody else has a different view, I'm open to hear. But my immediate answer, Anilji, is no, that should not be a requirement. Ji sir. So and this was, ji sir. And as I say, look, it's a code. When we say a code of ethics, everything, right or wrong, we've always deliberated in our meetings in the ESB and otherwise, or even in my office, when I'm, I come up with ethical questions. Answer, don't take it politically wrong. Answer can change with time as well, because the understanding of an ethical behavior evolves with time. I'm not saying it evolves with convenience. There's a very much big difference. Otherwise, why so many, globally the code has changed so many times. Why? It has changed because with the times, with the practical difficulties, deliberations, many more learned people coming in and applying their brains, practical experiences, the subject evolves. So the acceptability of what is good, what is wrong, what is bad has evolved in the human existence. And in the same manner, the code continues to evolve. And that's where I look at all the, fellow brothers, sisters, members who are attending, that, you may not find every answer in the code of ethics or a law, but the first gut feeling, your instinct, the first answer that you get from within usually is the right answer, usually. So I rely on that gut. I rely on that whatever sixth sense that you may say, that the first read, first hearing of the problem statement, if something comes to your mind, listen to that inner voice, because that probably is coming from the values and upbringing that you've had. And later, the fees takes over ethics. Later, our personal interest comes into the preferences, our relationships come into preferences, and then we tend to reconcile what we want as an answer to be the right answer. So that's a human nature. So thank you very much, Anil. Thank you.
Yes, sir. So thank you so much, sir. We have received this question, and if we receive the more question, then I'll definitely mail you and respond to the respective member. with your email reply, sir. And it was a wonderful deliberation, sir. Thank you so much from the core of my heart, as well as on behalf of CMP of ICI. I extend my heartiest thanks towards you for sparing your valuable time. And every time you are available for the cause of the profession, sir. Thank you so much, sir. Thank you so much.
Thank you. Pleasure. Thank you very much.
Thank you, sir. Moving towards the next session on GST. This is a very important topic for today. That is the input tax credit. Input tax credit, it's reversal of input tax credit, as well as the ineligible input tax credit. And if we talk about the section 4243, rule 4243, as well as its disclosure, so it is very important and apt one in today's time. So in order to tackle this, we are having with us CA Jagjit Singh Jack ji, the newly elected NARC member, a very eminent speaker, very renowned speaker, and he has deliberated on various soft skill topics, as well as the code of ethics, as well as on GST. So without wasting much more time, may I request Jagjit ji to please start his deliberation on GST, reversal of ITC, as well as the ineligible ITC. Over to Jagjit Singh ji.
Thank you, sir. Thank you, Anil sir. And
welcome, sir.
A very good evening to all the participants, those are listening me and available this in webinar. So first of all, my sincere thanks to the chairman of this committee, the committee of this member in practice, CS Sanjeev Singhal sir, and the vice chairman of this committee, Prasanna Kumarji. So thanks a lot for giving me such a wonderful opportunity and being a part of this webinar. So definitely I will try level best for discussing about this all about this reversal of GST with the rule of 42 and 43 and eligible ITC under the GST Act, ineligible, and I will try to mention something, but because the time is very limited, we have the 50 minutes to deliberate on this topic. I will try to cover section 17.5 also, the block of ITC, which could be like the better understanding for the profession. So I'm going to start. Yes, but I came without any presentation. I normally speak front before, front all the members. So if you have any questions, I have opened my chat box. You can ask anything during this my presentation. So I'm going to start.
Sure.
Right, sir. Thank you. So first of all, the very basic thing I want to start with this, the ITC under the GST. So what is ITC under GST? The very simply I have mentioned in this, my working paper. So everything is mentioned on the working paper. So ITC means the credit of the input tax paid on the inputs, and inputs cover three things. One is input goods, input capital goods, and the input services which we use generally to supply the taxable services, like which is taxable under the GST Act. The input tax in relation to the registered person, the person must, if the person is registered and the supplying the taxable services to the customer or to the other supplier as a input services. So that definitely there is a involvement of three taxes. It could be IGST, it could be a CGST and the SGST. It depends upon the interstate and the intrastate, right? So three taxes already covered in this, and the plus another one is UTGST. That is in the case of Union Territory, we generally charge this UTGST in the invoicing. Charge on any supply of the goods or services. If you are providing any services of the services or the goods which are taxable under the GST, obviously we charge the GST on that. And it includes the IGST paid on the import of the goods. Suppose we are importing some goods from outside India. In India, importing from outside, like from America, from Japan, from China. So it's a business transaction. All the businessmen, doing this transaction to running this business for the furtherance of this business. They are importing goods. They are importing, they are taking services from outside India. So that is taxable in India. And we generally receive the invoice, and on the invoice generally mention that is IGST, which we take as a ITC under the GST Act. And payable under the reverse charge, that is a new thing. under the reverse charge mechanism under the GST, section 9.3 and the 9.4, right? So whatever the section will be applicable, we cover in this. But exclude the tax paid under the composition scheme. If we are getting some goods, which the composition dealer, the dealer who is registered under the composition scheme and delivering some goods, on that goods we cannot take ITC of that goods, of that tax, under the composition scheme. We were getting invoice from the composition dealer. So we have covered. So one, we are receiving goods, we are receiving services, even we are buying the capital goods. And on all these three things, we are getting invoice mentioned as IGST, could be CGST, could be SGST, could be UTGST. So we are taking the input of all these, the taxes under the GST. We are taking the ITC of the reverse charge. When we are charging something at the reversal, we are depositing RCM and we are getting input. We are getting input of import services, the IGST on the import services, but we cannot take the ITC of the if we are getting goods from the composition dealer. So this is the basic thing we must understand before going further. Like what are these are the taxes which are available as a ITC and which may be not available for the ITC. Next thing, what is eligible ITC under the GST? This is very important. As per section 16(1), as per section 16 subsection 1, every registered person shall be entitled to avail the input tax credit if the goods and the service received is used or intended to use for the furtherance of business, for the business purpose. Suppose I am getting goods from the market, not for the business purpose, for my personal purpose. I am using that goods for my personal purpose, not for the business purpose, maybe for the consumable purpose. So in that case, the ITC is not available. So ITC available only when you are using the purchased goods for the furtherance of business. And the said amount shall be credited to the electronic credit ledger of such person. Now, how we will get the credit of that tax, on the supply which you are, receiving from the supplier? How we will get that credit in the credit ledger? So we have to file the GST return 3B. We have to file the GSTR, the annual return. We have to file the GSTR 1 for, putting that tax, submitting that tax, depositing that tax to the central government account. And if you are looking for the ITC under the GST, yes, you have to file the 3B first. So that is important. Subject to such other conditions. So section 16 subsection 2, what are the other condition and the restrictions? Restriction, why I'm saying this word restrictions? Because we have the rule 36 of the CGST rule of 2017, which totally relate to documentary requirement for claiming ITC. For claiming ITC, we have 4 basic conditions to taking that ITC as an eligible ITC. And what is that? Number 1, he is in the possession of debit note. The number 1 is possession of debit note. Number 2, having a tax invoice issued by the supplier or such other tax paying document as prescribed under Rule 36. So that is why I'm saying this Rule 36 is very, very important, because that support to the documentary requirement for claiming ITC. Without having a document, you cannot claim. You cannot claim, this ITC on the purchase. Just a minute. I'm just taking 1 second just to set this. Right. Okay. Got it. Yes. Next condition is he has received the goods. It means you must have possession of that goods which you have received the supply from the supplier, the taxable supplier, like the dealer who is registered under the under the GST Act. So you must receive that supply with you. And third one, subject to the filing of GSTR 3B and the claiming of ITC, which I have already mentioned. You have to submit the GSTR return and the return to claim that ITC under the GST Act, that is 3B, and must claim that ITC in that GSTR 3B on the monthly basis or on the quarterly basis. So depend upon, so no, if you are registered as a under the GST Act as a registered dealer, maybe you are complying, you are submitting your return on monthly basis or quarterly basis. That totally depend upon that. Fourth condition is also important. He has furnished the return under section 39 and must, in the third, must deposit the tax, the due tax to the central government account, either in cash or through utilization of the credit. So if we revise this section 16, subsection 2, so what are the four conditions? To claiming that ITC as an eligible ITC, 1, you must have possession of the tax invoice or the debit invoice, debit note, or some other relevant document which is prescribed under Rule 36. Second, must receive the goods, possession of goods. Third, must receive depositing the due tax by both supplier as well as recipient of the goods. Supplier of the service or recipient of the service must deposit the tax in the account of central government, and must be credited to the credit ledger of that particular supplier. And the fourth one, your GST 3B must be filed with the proper declaration, of eligible ITC in the proper disclosure, in the particular row, in the particular column which is mentioned in the 3B. So the fourth conditions are very, very important to claim that ITC. Now, if we talk about the latest notification which it came into the market, the notification number 40 and date 40/2021. The date of that notification is 29 December 21. Rule 36(4). We know that Rule 36(4) earlier, it was mentioned in that rule, you can take the benefit of the ITC as per the GSTR 2A, but you can take the margin of 5% where the invoice not received by you. But now the latest notification of 40/2021 dated 29 December 21, now there is a change. No input tax credit unless details are populated in the GSTR 2B. Furnish of detail of invoice, credit note in GSTR 1 or through IFF, right, by the supplier is now mandatory to take credit. It means this is a new form, which is as per the GST website available, and the form is GSTR 2B. So what are the ITC available on the GSTR 2B? Beyond that ITC, we cannot claim in our 3B. You can see, you can check, you can cross verify. Maybe the ITC available in the GSTR 2A is rupees 1,50,000. But on the other side, if you check the GSTR 2B, maybe the ITC is only 1 lakh. So in that case, you can take only the credit of rupees 1 lakh, not more than that. If you will try to modify that auto-populated figure in the 3B, because in the 3B, you will when you will check the ITC available in the 3B, that is auto-populated from 2B, GSTR 2B. If you will try to change that figure, if you want to enhance that figure by modifying, you will see there is a red alert. Your column, your figure will convert into another color, and that color would be red. That is the alert. That is the alert for you. You are claiming more ITC, as per that is beyond the 2B. So maybe in future, you will get some notice, you will get some clarification, maybe you will get some call from the GST department why you are claiming more ITC beyond the ITC available in 2B. So please keep in your mind, so rule 36.4, you cannot, according to the rule 36.4, you cannot claim ITC beyond the ITC available in 2B. That is the latest updates. A new section in section 16.2 of the CGST Act, after clause A, a new section involves 16 subsection 2 and in the bracket a small AA. The detail of invoice or the debit note referred in the clause A has been furnished by the supplier in the statement of outward supply, and such detail have been communicated to the recipient. Communicated to the recipient of such invoice or debit note in manner specified under section 37. So that information, information must be communicated to the recipient. So how it will be communicated? With the help of that GSTR 2B. So ITC to be availed only for those invoice whose details are reflected in GSTR 2B, that is the respective suppliers have filed in their GSTR 1. So please keep in mind, you cannot claim the ITC more than the ITC available in the GSTR 2B according to the latest notification 40/2021, and the date was 29 December 21. Very important. Now come to the next level. The time is very short, but the area is very, is major. Like what I have to discuss, what I have to, communicate through related to this reversal, that content is too much. If we think about the difference between 2A and 2B, GSTR 2A and 2B, what is exactly that? Please try to understand. The question would definitely arise. So whether to take form GSTR 2A or GSTR 2B as the base in order to fulfill the provision of Rule 36.4. So from my side, form GSTR 2B is a static and hence the same can be taken as a base for claiming ITC. Currently, the GST system is also auto-reflecting figures of the input tax credit in the form, as I mentioned, GSTR 3B. So all the ITC available as per GSTR 2B, that is auto-populated in the GSTR 3B. So my humble request to all the participants, to all the attendee of this webinar, please don't try to take more ITC than the ITC available in the GSTR 2B. If you want to take, because the supplier of this, the supplier of the good, the supplier of the service, or the supplier of the capital goods, maybe they have submitted their GSTR 1 after the due date. So that is why you are not getting that ITC in the same month. You will get in the next month. So you have the opportunity, you can take that ITC which is not mentioned in your current month 3B, this 2B, you can claim in the next month in your GSTR 3B, because that automatically auto-populated in the next month because they have filed their GSTR 1 after the due date. So that is why that ITC is coming in the next month. Or you can take that ITC up to the return of next year, September, 30th September, or annual return GSTR 9, whichever is earlier according to the rules. Now the next section is 17.1 and 17.2. Why I'm taking these two sections? Because both the sections talk about the apportionment of credit under section 17.1 and 17.2. Apportionment means because the ITC may be used for the non-business transaction. What is 17(1)? In case where the goods or service or both are used by the registered person partly for the purpose of any business and partly for other purpose, maybe for personal purpose. So 17(1) talk about where the goods used by the recipient for the business purpose and for the non-business purpose. So here we can understand where the recipient are using that goods for the other purpose, not for the business purpose, non-business purpose. So that ITC would be reversed in the 3B as well as in the GSTR 9. So before concluding my deliberation, my presentation, definitely I will show you with the help of the form 3B and with the help of the form GSTR 9 where that reversal must be disclosed. Now section 17(2). Section 17(2), section 17 subsection 2 talk about the case where the goods or service or the both are used by the registered person partly for effecting taxable services and partly for the exempted services. Please keep in mind one another important information. When I will say that taxable services, the taxable supplies, that must include the zero rated supply, because we can take the ITC on the taxable services as well as on the zero rated supplies, taxable services. We can take the ITC. So section 17 subsection 2 talk about where we are using that recipient of the goods or the taxable goods, and the ITC for the purpose of taxable services as well as for the exempted services. So in this case, the portion of the ITC which we have used for the exempted services must be reversed. I'm side by side mentioning everything about the reversal of ITC, right? Because the time is constrained. Now I'm going to share some condition, some situations where the ITC reversal is very, very important. So I need your attention. Condition for the reversal of ITC in GST, the condition number 1. A particular supply, the recipient failed to pay the consideration to the source within 180 days from the date of invoice, from the date of that tax invoice or the debit note. Suppose I have received some taxable services from the like the supplier of the taxable services, and that person issue one invoice. So in my books of account, that invoice is still outstanding, and the outstanding period is more than 180 days. I've seen while doing this GST audit, in the books of most of the client, they are not reversing that ITC in the case when they are not paying the full consideration including tax to the supplier of that taxable services. They are not reversing. They are not reversing with the help of this 3B. They are not reversing even before filing in the GSTR 9. They are not reversing. So the department has to must concern about this, where there is a turnover of 2 crore rupees or less than 2 crore, where there is no like the compliances of GSTR 9 and the GSTR 9C. Department must concern about this, where the turnover is 5 crore and less than 5 crore, where there is GSTR 9 is applicable, but the 9C is not applicable. In most of the cases, in most of the books of the client, they are not reversing because when we see the balance sheet, when we see the financial statement, when we see the financial statement of that company, we can easily understand, we can see with the help of accounts, the outstanding balance standing, and that outstanding balance standing even more than 180 days with the help of aging in the tally, with the help of aging in the SAP. We can check properly the payment of that tax invoice is not paid by the recipient of that taxable goods within a 180 days. So in that case, that ITC must be reversed. But after paying that tax invoice, the full consideration including tax, that ITC can be claimed by that recipient of goods. Next one. A depreciation has been claimed under the Income Tax Act on the GST component of the purchased goods. So if I'm buying something, the taxable goods from the market as a fixed assets, as a capital goods, so I'm taking GST as an input. I'm taking the input of IGST, I'm taking the input of CGST, SGST, I'm taking the input of UTGST, and side by side, I'm taking the depreciation on the full amount of consideration, full amount of invoice, including the GST component. So that is not available. That is not available to the assessee. Assessee can claim either GST input, ITC of the GST, or can take that depreciation on the GST portion. If the person taking the depreciation on the complete amount, on the full amount including the tax, then that assessee cannot take the ITC benefit. Because we know when we prepare the balance sheet, we generally charge the depreciation on the assembled value, excluding the tax portion. But when the person charging depreciation, including the GST portion, so that is not acceptable under the GST. So if any assessee, if any client claiming depreciation on the complete value, including the GST, then on that portion, that assessee has to reverse the ITC, which he has taken earlier and mentioned in the 3B. He has to mention that reversal of ITC in the column of liability and set up that liability with the input tax credit in the credit ledger, or has to pay with the payment. Third case, input were employed to create a tax exempt supply. So this is the case related to when the supplier of the services, when the supplier of the goods supplying or dealing in two turnover. One is taxable turnover, another one is exempted goods or the taxable goods. So in this case, we have to calculate the common credit. And we know that the institute has already given a material that is called the background material for the better understanding of the GST, the BGM already material available on the ICI website at the portal of Indirect Tax Committee. We can see the formula mentioned in that material. We can calculate with the help of that formula, and we can differentiate that common credit used for taxable service as well as for the exempted service. So we have to split both the ITC. First for the taxable service, another for the exempted services. So the portion of exempted services where we have utilized ITC for the exempted services, that portion must be reversed in 3B and GSTR 9. Next one. Some of the supply manufactured using input were used for the personal or non-business purpose. As I mentioned, right, in the earlier, when I mentioned about this, section 17, subsection 1, where a supplier using ITC for business as well as for non-business services. So in that case, we have to split that available ITC in two parts. One is for the business services, another for the non-business purposes, non-business services or supplies. So when we can differentiate with the help of that formula, which I have already mentioned in the BGM, that is available in the BGM. So with the help of that formula, when we differentiate that ITC in the business purpose supply and the non-business purpose supply, so that ITC which we have used for the non-business purpose, that portion must be reversed in 3B and GST 9. Next one. When we talk about the banking business, we know that in the banking business, we have the scheme. One scheme is you can take the ITC of every services which you are getting, and another scheme is, right, without doing so many compliances, you can take the 50% of the ITC available as per 2A, now as per 2B. So in the case of bank, the reversal of 50% of the ITC financial institution or the banks under special rule while filing their return. If the bank is taking the 100% ITC, but that bank is under the scheme of 50% without doing further compliances, in that case, the bank has to reverse that 50% or more than 50% which the bank has taken the benefit of ITC reversal in the form 3B and GST 9. As we know, the 1st July 2017, in the case of the amount of ITC, transitional ITC, 5/6 of the amount of the ITC taken on the gold in the stock must be reversed. So I'm just adding one new things. The rule 44A, the balance transitional ITC to be reversed on 1st July 2017 in the case of gold bar. And this rule relate to ITC taken under the transitional provision of the CGST Act, where the stock of such gold bar or the gold jewelry, whether in raw material or in the finished product, lies with the taxpayer as on date 1st July 2017. In that case, ITC will be restricted to 1/6 of the total ITC. It means in that case, 5/6 of the credit availed must be reversed. I don't know in how many cases they have reversed 5/6 portion of the total ITC. So that was in the rule 44 of the CGST Act. Next one. ITC availed on the block credits. Now we can understand the section 17 subsection 5 that talks about the block credit. After 2 minutes, I'm going to start that section 17 subsection 5, and that will talk about the block credit. While submitting regular return and until submitting the annual return, if you have taken any ITC on the block credit, which is block credit under section 17 subsection 5, that must be reversed with the help of 3B or with the help of annual GST 9. That must be reversed. Next one. Input used in the loss of goods, stolen goods, destroyed goods. When you are filing your regular tax return, that is 3B, for the month of in which the loss occurred. Suppose you have buy something, the taxable goods from the market, and that goods stolen. There is a loss of that goods in your factory, maybe the fire occurred, destroy of that goods, the wastage of that goods. So there is a responsibility of the taxpayer to reverse the ITC on those goods which are lost, stolen, destroyed during that period. In which period they have destroyed, lost and stolen? In the same month when you are going to file for that particular month return, that is 3B, we have to revert the ITC on that particular goods. Last one, input for the things that were either utilized or distributed for the free sample. We know that in the big industry, when they are going for trade fair, when they are going for some, the big market, so definitely they are doing, they are participating in the trade fair and they are supplying that goods in the trade fair counter and showing. Sometimes they are distributing as a free sample. So if you have taken ITC on that goods which you have distributed as a free sample, then the portion of ITC on that particular free sample goods must be reversed in the 3B and GSTR1 in that particular month return. So what we have discussed, I'm just revising in 1 minute. First one, particular supply recipient failed to pay the full consideration against the tax invoice within 180 days. That is one. When you have charged depreciation on the GST portion, the tax portion also, so you have to reverse the ITC if you have charged depreciation, if you are claiming depreciation on the full tax invoice including the GST portion, then we have to reverse. Third one, input were employed to create the tax exempt service when there are two tax services, one is taxable, another one is exempted service together. Supply manufacturing using input were used for the personal as well for the non-business purpose. We have to reverse on the non-business purpose where we have utilized that ITC. And in the case of bank, the 50% of the ITC we have to reverse if the bank is claiming the 100% of ITC, but the bank is taking the scheme of 50% utilization. So the other compliances should not be maintained. So the other compliances, the responsibility of the compliances should not be on the bank. So 50% ITC should be reversed. And in the case of 5/6, the reversal on the gold bar as on date, the stock available the 1st July 2017 as per rule 44, which I have already mentioned, the 44A of the CGST. And the ITC available on the block credit, that must be reversed. And the goods stolen, goods damaged and destroyed, reversal of ITC. The last one, utilize the goods, the goods on which you have taken ITC but utilize for the distribution of free sample. So these are some conditions. Now I'm going to add section 17(5). So I will take another 4.3 example because I have to show the calculation, how to calculate that common credit and how to disclose because the time is limited. So I will just add 2-3 things, important 2-3 things. Right, first one is section 17, subsection 5 and subsection small a and double A. ITC on the purchase of motor vehicles and conveyance for the personal use, a motor vehicle with sitting capacity up to 13% purchase of aircraft and the vessel. Up to 13%. Please keep in your mind, please, I need your attention. Very important things. ITC on the purchase of motor vehicles, conveyance for the personal use, motor vehicle with sitting capacity up to 13% or less than 13% could be. Purchase of aircraft and vessel, ITC not available. If we talk about on the other side, if the vehicle having the capacity of more than 13%, even including driver, ITC available. Motor vehicle used for the transportation of the passenger having the capacity of 13 or less than, ITC not available. The input tax credit is also not available on the purchase of aircraft and vessel, as I mentioned earlier. Now, some exceptions are there. When motor vehicle or vessel or aircraft is used for, need your attention, further supply of such vehicle, vessel or aircraft, means the SSC is already involved in this, the particular business of sale purchase of this vehicle, vessel and aircraft, ITC is available. Transportation of passenger more than 13% capacity, ITC available. Imparting training on driving such vehicle, ITC available. If you have the business and you are training, you are providing training on driving such vehicle, including training to operate vessel and aircraft, ITC available. Next, section 17, subsection 5 and another bracket, small ab. General insurance, service, repair and maintenance of vehicle and vessel. So in this case, where the service, right? So ITC is not available. But repair and maintenance of vehicle used for driving schools, where the nature of business is to provide the training, like they are running the driving school to giving, they are doing the training to they are training to the driver. In that case, on the repair and on the insurance, the ITC is available. Third section, 17 subsection 5 and small b. Supply of foods, beverage, club membership, beauty treatment, surgery for personal use or office party. In this case, some exceptions are there. ITC is not available, but in the exception, something is mentioned that is very important. So please listen. When such services are used for furtherance of business, the ITC is available. Where it is obligatory for the employer to provide such supply to its employee under the law, ITC is available. So two conditions. For the furtherance of business, ITC available. When there is an obligatory for the employer to provide such supply to its employees under any law, that time being is forced, ITC available. Next one is a travel for personal or business purposes, vacations, holiday, etc., where LTA is provided to the employees. In this case, if that traveling is related to business purpose, so ITC is available. When the director is going for the vacations, not for the business purpose, for the family purpose, for the personal purpose, ITC is not available. Next one, section 17, subsection 5, small c. Sorry, E. Yes, it's a C. Work contract. Let's talk about work contract. ITC on the work contract service used for the construction of immovable property, ITC is not available. But when input service for the work contract used for further supply of work contract, in that case the ITC is available. I'm repeating. Input services of the work contract used for further supply of work contract for the main work contract, in that case the ITC is available. So we have to understand each and every section, each and every concept, each and every point to understand where the ITC is available, where the ITC is not available. Where the ITC is not available, that is ineligible ITC, and that ITC must be reversed with the help of GSTR 3B and with the help of GSTR 9 on the annual basis. Next one, Next one is construction service. Section 17, subsection 5, small d, construction of immovable property for the personal use. So when there is a construction of immovable property for the personal use, ITC is not available because the personal use is not the use for the business purpose. So that is ineligible. Goods or service received for the construction of immovable property on his own account, that is not available. Goods or services used in the construction of plant and machinery. Suppose you are running one plant. In that plant, you need some construction. So on that portion, the ITC is available. I'm repeating the same point. Goods or services used in construction of plant and machinery, then ITC available. Goods or services or both used for the furtherance of business, ITC available. And to understand this construction part for the plant and machinery, a very important clarification I'm going to share with you. The construction includes, first I'm talking about the construction of immovable property. Then I will talk about the construction for the plant and machinery. First is for the construction of immovable property. Construction includes reconstruction. Reconstruction also for like construction, renovation, addition, alteration, repair to the extent of capitalization to the said immovable property. So everything's covered in this. ITC is not available. A big no. No ITC is available. Next one, the plant and machinery means equipments and machinery fixed to the earth. We know that if we want to install a big machinery, we must have, the base, the concrete base for that, and for installing that particular machinery. So the fixed to earth by the foundation or the structure support that use of for making outward supply to put to you that machinery. So that is why we need that the concrete base for installing that machinery, right? Erection of that machinery. And for the good service or both include such foundation and structure support, ITC is available, but exclude. So what I mentioned plant and machinery means equipment and machinery. If we are buying some equipment, buying some machinery, and we are fixing a fixed to earth by foundation, structure support, used for making outward supply of the goods and the services, or the both include foundation, ITC available, but exclude. But exclude what? Land and building or any other civil structure. Suppose I am creating some other structure beyond that part of machinery. That is, on that portion, the ITC is not available. If we have taken ITC, we have claimed ITC in the 3B, we have to reverse. Next one, telecommunication tower. If we are installing, if you are erecting, we are creating some. So in that case, ITC is not available. Pipeline laid outside the factory premises, ITC is not available. Now the section 17, subsection 5, bracket mein, small e, purchase from the composition scheme. If we are purchasing, if we are buying something from the composition dealer, ITC is not available because that person is not liable. That person is not liable to issue a tax invoice. Section 17, subsection 5, bracket mein, small f, a goods or services received by a non-resident. That is very, very important, sir. Please, I need your attention again. That's very important. A goods or services purchased within in India by the non-resident taxable person. Goods or services purchased within India by the taxable person. ITC not available. But if the same goods purchased by that non-resident taxable person, but outside India, ITC is available, IGST. Right, sir? So I'm not repeating because the time constraint. Section 17, subsection 5, small g, goods or services for the personal consumption, ITC not available, big no. Section 17, subsection 5, small h, free sample, gift, lost, stolen, and destroy goods I have mentioned earlier in the special cases. Section 17, subsection 5, small I, any tax paid in accordance with the provision of section 74. Please keep in mind, very important section I'm going to discuss. Section 1774, section 129, and section 130 of the CGST Act. What is that? In all the three cases, if we talk about section 74, if I talk about section 129 or 130, ITC is strictly prohibited, not available. Section 74 talk about the tax not paid or short paid due to fraud, excessive refund. If you have short paid, fraudulently, intentionally, or you have claimed refund, excessive refund from the department, ITC not available. Even when you will reverse that reversal of that ITC, which you have taken under section 74, 129, 130, you have to pay penalty plus interest, and the rate of interest would be 24%, not 18%. Next section, section 129, detention of goods, seizure of goods, and release of goods, and the conveyance in transit. In that case, the reversal of ITC is much required. No ITC, ITC is not available, ineligible ITC. Third one, section 130, confiscation of the goods or the conveyance and the levy of penalty. We know the rule 138. The compliance is for the purpose of e-way bill, generating e-way bill. If you have not generated e-way bill and your goods is confiscated or detention, section 129, 130, ITC will not be available to the SSC. So we have to reverse even with the penalty or maybe with the interest, and the rate would be 24% per annum. Last two, the goods and services purchased for the exempted supply. If we have utilized any ITC against that exempted supply, we have to reverse. No ITC allowed on the payment of late fees, penalty, interest. No ITC available. And some special cases, I will take another 4 minutes. Then I will go for the calculation part. I will show, I want to share the small screen for the benefit of members so that they can understand. So how to calculate that common credit and how to differentiate that common credit into the eligible and the ineligible ITC. Special cases of the ITC under GST. Section 18, subsection 1, small a person who has applied for the registration within 30 days of becoming liable for the registration is entitled to take ITC of input tax credit in respect of the goods held in stock. If I have applied for the GST, registration within the 30 days from becoming a liable for the registration, so yes, I can claim the ITC on the goods available with me in the stock, whether raw material, semi-finished, or the finished goods, even on the right, but not on the capital goods, right? Next one, section 18, subsection 1, small b, a person who has taken voluntary registration. The first one was that person was liable to get registered under GST because the taxable supply. But in the second case, Section 18, subsection 1, small b. In this case, the voluntary registration taken by the assessee under the section 23, subsection 3 of the CGST Act 2017, entitled to take ITC on the input tax in respect of the goods held in stock, whether raw material or semi or finished, but not on the capital goods. But if we talk about the section 18, subsection 1, small c, a person switching over from normal scheme, switching over to normal scheme from composition scheme. So what is happening in this case? What will happen in this case? A person switching over to normal scheme from a composition scheme. Then the ITC available on the input goods, raw material, semi-goods, semi-finished goods, and the finished good, and plus, that is a new point, and plus on the capital goods, but on the proportionate basis. Proportionate basis means because under the GST Act, we know that every asset's having a life of 5 years. So if you want to take the ITC on the life of capital goods, so we have to divide that asset divided by 60 per month in the 60 months. So on the balance portion, on the balance remaining life of that capital asset, we can take the ITC, right? Suppose we are shifting to normal scheme from the composition scheme, and we have one asset where that asset's already 3 years old. So we have 2 years remaining. So what we will do, we will take the value of that capital goods divided by 60 and multiply by 24 months. So we can take the benefit. Section 18, subsection 1, small d. Where an exempt supply of the goods or the service or both become taxable. Suppose you are running your business and the business you are dealing in the exempt supply, but due to change in the law, that exempted supply now converted into taxable supply. So you can take the benefit of ITC on the complete portion of your stock in hand, whether raw materials, semi-goods or finished goods, plus the capital goods which you have in your books of accounts, right? So in the last, I'm just mentioning one note. Input on such capital goods held in stock will be available under the section 18, subsection 1, small c, and 18, subsection 1, small d. Input on such capital goods would be reduced by 5% per quarter or part thereof from the date of invoice. So that was the, what I have mentioned. It's all about the ITC eligible and ineligible. Where the ITC is ineligible, so that portion must be reversed with the help of 3B and with the help of GSTR 9. Now I'm going to share one slide. I will take another 2 minutes, 2 page. So can I share my, sir, do we have the permission to share the slide?
Yes, sir, you can.
Okay, sir. Thank you, sir.
So you may share.
Yes, sir. Yeah, this is the slide.
Sir, you may share.
So are you getting, sir? Are you able to see?
Yes, sir.
Yes, sir, we are able to.
Okay, thank you. So this is what, with the help of this calculation, we can understand so how to calculate that common credit and how to differentiate that common credit into the business purpose and the non-business purpose supply and exempted and taxable supply. So this is the first one. Talk about rule 42. Let's talk about rule 42. With the help of this rule 42, the manners of determination of ITC in respect of the inputs and the input services and the reversal thereof. It's a simple formula. We can read this formula from the BGM, the background material, but very important thing is to understand these terms. So I'm just explaining for your help. So the T is the point is T. T represent the total input tax credit paid on the input and the input services. That talks about the total input tax. And T1 talks about the only this non-commercial use purpose, the ITC for the non-commercial use purpose. And T talks about the like the exempted deliveries, not taxable, but the exempted deliveries. That exempted deliveries represent T2 by the T2 with the help of T2. And T3 represent the block credit under section 17(5). So first step, we have to determine the T, we have to determine T1, T2, T3. So how we can determine, how we can calculate this T and T1, T2, T3? So when we will check the books of accounts of the client, yes, the sum of the accounts are specifically, differentiated by maybe the client, maybe you have to apply your mind and you can differentiate that particular amount of ITC and different T, T1, T2 and T3. T, we know that the total ITC available, that is easily available in the books of account, that is easily available in the tax credit register or the other register. But T1, T2, T3, we have to calculate. We have to working on that. Then the next step 2. So what is step 2? Step 2 means the subtract T1, T2 and T3 from the T actually. The total ITC minus T1. And T1 is the ITC on the non-commercial uses. And T2 is minus the input on the exempted deliveries. And the T3 is basically the ITC on the block ITC. So when we will deduct from the total ITC, the exempted ITC on the exempted supply, the ITC on the non-commercial means the personal ITC, the services, and the last one is the block ITC. So it will come to know the next figure would be the C1. C1 shows the ITC credit to the electronic credit ledger. Please, I need your attention on the screen. So I'm just, with the help of my mouse, I'm just showing the ITC credit to the credit ledger. That is C2. When you will calculate C2, so the next step would be to calculate C1. When you have calculated C1, the next step would be to calculate C2. And C2 stands a common credit. C2 represent a common credit. How to calculate this common credit? C1 minus T4. And what is T4? T4 is already, or maybe you have to apply your mind to calculate the specific credit for the input services used solely to make taxable services. And this category includes the zero rated supply. As I have mentioned earlier, the taxable supplies, I have mentioned earlier, when I will use the taxable supply, it means it includes the zero rated supply also. So when you have the T4, so what you have to do to calculate this common credit, so C2 is equal to C1 minus T4. So now you have calculated C2. Now the step 3. Now the step 3. So how to calculate this D1? And D1 stand for what? D1 is basically the ITC attributable to exempt supply derived from a common credit. So maybe in the common credit there is a portion of the ITC which is related to this exempt supply. So how to calculate? So we have to calculate with the help of formula E divided by F and into C2. C2 already we have calculated. And what is E? E stand for a total turnover in the state for the period or maybe for the annual where the registered person stayed during the tax period, right? So this is what, this is the exempted, and this is what the total turnover in the state where the registered person stayed throughout the tax period. So E talks about the exempted, and this is for the total. So now in the next page, definitely I will show you one numerical basically with the help of numerical, I will show you how to calculate. Now the next is D2. D2 is fixed, basically the 5% of the C2. And D2 is what? The considered to be the ITC traceable for the non-commercial reason. So when you are going to calculate non-commercial reason, always apply the same formula, 5% of the C2. So C2 you have already calculated. Now the last one is the balance ITC out of the common credit, which is a eligible ITC. So how to calculate? C2 minus bracket start D1 plus D2. D1 for the exempted supply and D2 for the non-commercial supply, right? So D3 is now you have calculated. So based on the calculation above D1 and D2, D1 means exempted supply ITC related to exempted supply from the common ITC, and D2 is the non-business ITC from the common ITC. So now these two should be reversed. So ITC that must be reversed. So how to calculate? Now see the one example. This example is already available in the BGM, background material of this GST. So here we can say that T is total input tax, CGST 1 lakh, SGST 1 lakh, IGST 50,000, and T1 is mentioned exclusively for the purpose of non-business purposes, that is 10,000, 10,000, 5,000, and the next one is exclusively for effective exempt supply. Earlier one, the second was non-business. The third one is for the exempt supply, that is 10,000, 10,000, 10, 5,000. Now the T3 is basically for the blocked ITC 17.5, section 17.5, 17 subsection 5, 5,000, 5,000, 2,500. Now the total is for what? Total is for T1 plus T2 plus T3, that is total 25,000, 25,000 and 12,500. So when we subtract this total from total T, so automatically the balance would be the ITC credit to the electronic credit ledger, that is C1 is equal to T minus T1, T2, T3, that is 75,000, 75,000 and 37,500. So Mr. Anil sir, Lal sir, I will take another 5 minutes to conclude this presentation.
Okay, sir.
So
Okay, sir. Okay.
Thank you. So next one is the input tax credit used exclusively for the taxable supplies. As I mentioned earlier, when I will use this taxable supply, it includes the zero rated supply. So this is T4 is totally purely for the taxable supply, 50,000, 50,000, 25,000. So now you can see the common credit would be C2. The formula is C2 is equal to C1 minus T4. So what is C1? C1 was 75,000, 71,000 and 37,500, and T4 was 50,000, 50,000, 25,000. So the C2 is 25,000, 25,000 and 12,000. So now the aggregate value of the exempted supply for the tax period May 2018. So we have to check this note number 2 and note number 3. Exempted supply already mentioned 25 lakhs, 25 lakhs and 25 lakhs. Total turnover of the registered person, that is 1 crore, 1 crore, 1 crore. So if we calculate the percentage, so no, I have already mentioned E divided by F. If we check E divided by F, it means 1/4. So now the credit attributable to the exempted supply. So D1 is equal to E by F multiply by C2. So E by F is 1/4 and into C2. So what is C2? That is 25,000. So if we multiply 25,000 by 1/4, it comes to 6,250, 6,250, and in the case of third one, the 3,125. So we have calculated D1. Now calculate D2. So D2 is for the non-business purpose. So there is a fixed formula that is 5% of the C2. So what is C2? So C2, 25,000, 25,000 and 12,500. So what is D2? So we multiply by 5%, that is 1250, 1250 and 625. Very easily we can calculate this D2, right? So what would be the reversible amount? So net eligible common credit is equal to what? First calculate this. So C3, which is also, the eligible common credit available for us, which is not reversible, which we should not reverse. We should not reverse in the 3B and GST 9. So C3 is equal to C2. What is C2? 25,000 minus D1. D1 is 6250 and D2 1250. So it will come about 17,500, 17,500 and 8,750. So now the total credit eligible. So how we calculated this eligible total credit? So first one was this 50,000. Please check this T4. T4 is 50,000, 50,000 and 25,000 plus this common credit 17,500, 17,500 and 8,750. So total about this 67,500, 67,500 and 33,750. So that is the total credit eligible. So what should be reversed? What should be reversed? These two should be reversed. This 6,250 plus 1,250 and same with the SGST, CGST, and in the case of IGST, 3,125 plus 625. So these are the portion which we will reverse in the 3B and in the GST Tier 1. So this is the portion to be reversed. So now the last one to calculate this, rule 43. So as I mentioned, the total credit on this, the capital goods divided by 60, so that we can calculate the TM. TM stands for the tax on the monthly basis, the ITC on the monthly basis. And what is TR? TR is total input, tax input. It includes a tax on monthly basis for the earlier capital goods, further tax on monthly basis for the current tax period, because some of the capital goods we have purchased in the last year or maybe in the last month, but some of the capital goods we have purchased in this month. So that is why it's a total of both is equal to TR, and TE is equal to tax on exempted. So same formula is there, E by F into TR, so that we can calculate the total input tax credit. And E and F already I have explained. So now see the another examples. ABC Private Limited is engaged in providing exempt as well as taxable supply. When we are mentioning exempt as well as taxable supply, it means there is a question of a common credit. There is a possibility of common credit. The detail as given below for the month of November 2020. So please keep in mind this information. The value of exempt supply is 15 lakhs. The value of zero rated supply is 4 lakh. The value of taxable supply is 26 lakh. The supply made for personal use 5 lakh. So overall the total turnover would be, it's a 50 lakhs. 50 lakhs? Yes, 50 lakhs. And the taxable supply, zero rated as well as taxable supply means 30 lakhs. Now, the particular of CGST, credit of capital goods used for providing exempt supply, CGST 10,800, SGST 10,800, and capital goods used for providing taxable services, including zero rated, 45,000, and credit of the capital goods used providing supply for the non-business purposes, that is 11,700. Now, it is easily understandable that the first one is 10,800, that is providing for exempted services. So automatically it's directly reversed with the help of this, a GST 9 or 3B. And if we talk about the last one, the non-business purposes GST 11,700 directly. But what about other? So we have to calculate the common credit. Now, so purchase of the goods only capital goods 3 is purchased in the month of November 2020, but other purchase in the previous year, as I mentioned. Capital goods 1 already purchased 50,400, same in both the cases, CGST, SGST. Capital goods 2, 23,040, and capital goods 3, 41,040 in both the cases, CGST, SGST. And that capital goods 3 purchased in the month of November means for the month of November, we are talking about month November 2020. So that is why we will claim the full amount of this 41,040, right? So total input tax credit for the taxable supply, including the zero rated. So what was that? So I have mentioned at the, like this, 45,000. 45,000 I have already mentioned at the upper side. This one, the credit of the capital goods used for providing taxable services. So that is 45,000, 45,000 directly, put that figure, that figure from there to here, 45,000, 45,000. And this is what 41,040 that I've taken because I'm talking about November 2020. So this total ITC on the capital goods, which we have purchased in the month of November, we are talking about the month of November. So total complete ITC I've taken here, 41,040. Now, just another 1 minute. So TR is equal to the TM of all the capital goods, right? All the capital goods that I have calculated at the bottom in the working note, 1908. How this 1908 came out? This is the calculation. So what I've done. So for capital goods first, total value was 50,400 divided by 60, so that I can calculate the figure for the month of November 20. So that is why I divided by 60. Same with the CGST, SGST. Capital goods 2, 23,040. The total ITC was there. Divided by 60, so that I can calculate the figure for the month of November 20. Right? That is 384. And capital goods 3, 41,040 divided by 60, 684. Why I have calculated, for this capital goods 3, because I have to calculate the common credit for all the 3 capital goods 1, capital goods 2, capital goods 3. Now the total of this for the month of 1908 in both the cases, CGST, SGST. So now the figure come here, 1908. And input of the capital goods to the exempt supply. So how to calculate exempt supply? The percentage E by F into TR. So TR is 1908 and exempt supply. So how we have calculated for that, right? Very simple formula, E by F. This one, E by F, where E is what? 15 lakhs and F is 50 lakhs, right? So exempted is 15 lakhs and full tax, the complete turnover is 50 lakhs. So when we calculate, so multiply this 15 lakh into 1 minute. This one. So how this 572 come out? So TR is 1908 into 15 lakh divided by 50 lakhs. So the figure come 572 and 572 in both the cases. So now this is the last figure, the total ITC on the capital goods for the month of November 2020. So that is 45,000 plus 41,040 and plus 572. Sorry, minus 572. Minus 572. So the figure will come out 85,000. Yes, 85,468. So with the help of this formula, we can calculate the common credit so that we can reverse the proper figure in the GSTR 3B and in the GSTR 9. So now the last point. So how to disclose this? If we are going to disclose reversal of ITC in the 3B, so in the table number 4, you will see in the part B, ITC reversal. There are 2 points which mentioning. First one is as per the rule 42 and 43. So we have to club 2 things. One is when we are going to club, one is exempted and non-business transaction. So club that ITC which is related to exempted supply or the non-business supply. So club that ITC and mention in front of this as per rule 42 and 43. But other than that means if we talk about the block of credit, then the other portion in front of others, we can mention the reversal of ITC. So same with in the case of GSTR 9 for the exempted as well as for the non-business in the table number, in the GSTR table number. Yes. So here we can mention point number B, ITC reversal 42 and 43, the clubbing of the ITC, ineligible ITC against the exempted supply, ITC which we have utilized, and the non-business purpose ITC which we have utilized. So the clubbing of both we can mention in front of rule 42, 43, and other block. If we talk about the other block of credit under section 17, subsection 5, we can represent here. So this is all about from my side. So now over to Anil sir. Over to you. Thank you, sir.
Thank you so much, sir. Thank you so much. It was wonderful deliberation. Can you hear me?
Yes, sir. Yes, sir. Yes, sir.
बहुत अच्छी deliberation, sir. It was wonderful, nicely explained. Matlab, hats off to you, the way you have explained, the way you have cleared the doubts, and the way you have explained how to show. It was really superb, sir. It was really superb, sir. Sir,
So
I have few questions for you.
Yeah, please, sir.
Sir, first question is, when the person becomes liable for registration and is entitled to take GST credit on his stocks,
so
when the person becomes liable for registration and he is entitled to take GST credit on his stocks, how this credit can be claimed, as this will not be reflected in 2B?
Actually, you know what we have to do. We have to give some declaration that the stock which that person laying with him, right, at the time of applying for the registration. Suppose today I am going to apply for the registration and I want to take the ITC on the stock which, in my hand, in the shape of raw material, in the shape of semi-goods, in the shape of finished goods, right? But depend. I can take the credit of capital goods, which I've already mentioned. But if we talk about the first part, yes, I can take the credit of raw material, semi, and the finish. But I have to give some declaration to the proper officer that these type of stock standing with in my store and in my hand. So I have applied the registration under the GST Act within 30 days. So I want to take the ITC. So with the approval of this proper officer, that declaration, so that portion I can take and directly create an entry in the tally or in the SAP. So I can pass that entry, but with the proper approval from the proper officer.
Okay, sir. Okay, sir.
Document must be certified from the proper officer, and that person is satisfied.
Ji.
Right.
Sir, there is another question regarding the real-time query. The member is saying we have paid IGST of rupees 4 crore under the search of DRI, Directorate of Revenue Intelligence, and held under Custom Act. Such IGST was paid in cash by filing the challan TR6 at AD banks. Now we want to take ITC of such GST paid, as it is not displayed in GSTR 2AB as paid offline. So how can we claim such ITC?
So for that purpose, this is a offline working actually, because that question does not come on the portal actually, because that TR6 is when the department is raising some demand and creating some, the demand of any tax with the help of, and they are saying to the SSC, okay, please pay that amount with the help of TR6. So that entry, that tax, the payment of that tax does not come on the portal actually directly. So what they can do, they can write a letter to the, the superintendent, those have received that TR6 challan, or that person can recommend, put a mark on that, and that portion, that letter will go to the the central of what I would say, like one copy to the proper officer and one copy to the EDP cell of this GST department. So that GST department of the EDP cell at the central level will add that amount directly in the credit ledger of that SSC. So that's why the credit will come to in the credit ledger. Otherwise, there is no any mechanism to take the credit, because that amount is not represented in the 2B or 2A.
Ji sir. Because this was purely relating to the offline.
Yes, it's a practical knowledge actually. It's not a theoretical knowledge. It's not.
It is a practical knowledge.
With the help of this portal. Portal is not supporting such kind of working. Yes, sir.
So one more query: does the timeline for availing ITC apply before the September of the subsequent financial year to the reverse charge invoices?
Actually, I would say the timeline is the annual return or the return of the September, which we will file in the month of October. The due date is 20th October, right? 3B. So whichever is earlier. So that is the last timeline.
Yes, sir.
But except if there is a change, or the extension of the date due to some technical reason, then the department can accept or consider the reasonable causes and will give you the opportunity to take the credit up to that date, the extended date.
Yes. Sir, is it compulsion to have physical tax invoice for ITC? Availment or a digital signed invoice is adequate?
Yes, of course. Section 16 only talk about this condition. Section 16 subsection 2 only talks about the 4 condition. You must have possession of tax invoice, because someone I was discussing with one of the very senior member, and he was saying, Mr. Singh, my client is receiving the invoice through the mail, whether that invoice, the e-invoice is sufficient to take the credit. I have replied to him that if that invoice having the unique ID code, when we generate an invoice through the portal,
yes,
so that will create a unique ID. If such kind of invoice the client having with him, then the client can take ITC with the help of that invoice, e-invoice, right? But if the client is without any e-invoicing and don't have having the soft copy of that invoice with the help of email, so that invoice, that copy, that soft copy is not sufficient. But if the invoice through the portal, that is e-invoicing, is available with the client, whether on the mail, so that invoice is sufficient, where there is a barcode is there, unique ID is there. Yes, sir. Anything else?
Yeah. Thank you so much, sir. Sir, these were the questions for you.
Yes,
thanks a lot for your wonderful deliberation. On behalf of CMP of ICI, I extend my heartiest thanks towards you for sparing your valuable time for this wonderful deliberation, sir. Thank you so much, sir.
Pleasure, sir. Thanks a lot. Thank you to all the team members, all the committee members, technical team, and of course you, Anil sir, Sanjeev Singhal sir, very respected Central Council member, and Prasanna Kumar sir. So thank you.
Sir, thank you so much. Thank you so much. Thank you, sir.
Thank you. Thank you.
Thank you, sir. Thank you. Namaste.
Namaste.